Hi. We have recently done a live session with our followers on options decoding, wherein we discussed some of the important concepts like the time value and the intrinsic value of an option, which can help us understand which strike to be selected, which can give more ROI, and which has the more risk potential and all that. Then we went on to discuss the option sellers mindset, how they create the open interest, which can better understand the option chain data. Then finally, we discussed about the expiry day strategy that we follow. What is the exact logic behind that and why it can work most of the times, etc. So if you're an expiry day trader, don't miss it out. And let's get started. Yeah. So before understanding the strike selection, you need to understand a concept called intrinsic value and the time value of an option. For example, let's take option chain data. So this is the option chain data of Nifty. Now, if you see, this is for the expiry of 24th expiry, which is coming Thursday. Now here, if you see, what is at the money? So these are the strike prices basically. And here we can see the option value. These are the calls and these are the puts. So here is the option value here and here is the option value for the calls. And this is the actual value, the total value. For at the money option, if you want to buy a call option, one lot, if you want to know the value for lot, you need to enable this. Then you will be getting the actual value of one lot of call option of Nifty for 24th November expiry. Now, if you want to purchase 18,350 one option, it is costing you 4,635. So which is 4,600. For call options, understand these terminologies. One is in the money, at the money, out of the money. For call option, first you need to figure out what is at the money. Now we know that at the money strike is nothing but whichever is closest to this one, 18,000, this is the spot price. So whichever is closest to the spot price, that will become the at the money strike price. Now this is the at the money strike price. If you take it, then whatever the strikes which are below, the value is these are below the at the money strike price. These are all called as in the money strike prices. And whatever the strikes which are above the at the money strike price, these are all called as out of the money strike prices. Now, let's combine and understand why there is so much of a difference in the value between at the money. Now, at the money is 4,600. So 4,600 is at the money. And if you go for 2 legs out of the money, that means if you go for 18,500, it is only, you can buy it only with 1,750. But if you go for 2 legs in the money, like this, then you can see that it's costing you 9,600. This is the value. So one is costing you almost 10,000 rupees. One is costing you somewhere close to 5,000 rupees. And one is almost close to 2,000 rupees. So there is a difference. So you, as and when you're going in the money, no, the price increases because the option premium is increasing. But why it is increasing is the main question. Because understand, every option will have two values inside it. Let me explain an Excel sheet. Yeah. So for example, if you take a call option, let's take this only. Because if you can understand this one particular topic clearly, just a second. Okay. Yeah, just let me know if you can see the screen or able to see the screen, right? Some are not able to see it seems. Can you see the screen? Okay. Fine. Yeah, most of them are able to see the screen. If you have any other issues, maybe you can exit and then try to rejoin. So the volume, voice and the screen presentation is all fine. Yeah, it's the option screen. So maybe issue could be from your side. Check it from your side. Okay. So let's take this one only. Now for Nifty, at the money option is trading at 4,635. So we'll go for ATM. Nifty, which is 4635. Now for every option will have two values inside it. One is time value and one is intrinsic value. Now let's calculate what is the time value and intrinsic value for at the money, in the money and out of the money. Now we'll take at the money first. At the money is 4635. To actually calculate, when you're actually calculating time value, you should not take the total lot value. You must divide it by 50. So you'll get the actual premium value. Now this is 92.7. That value only you can see it here. If I remove this particular one, you can see this 92.7. If you multiply everything with lot size, you will be getting into 50 because lot size for Nifty is 50. Now let me remove this. Let's take these values first. This is 92.7, right? Now 92.7, let's keep it here. Now this will have generally two values will be there. One is time value and one is intrinsic value. So what is the formula for intrinsic value? There is a formula which is spot price minus strike price. Spot price means whatever the Nifty is there, that is the spot price, which is 18307. Now here itself I'll show you 18307 is the spot price minus what is the strike price? 18350. So 18350 is the strike price. Now the difference if you do, you are getting some negative, some 40, 43 or something you'll be getting as negative. But remember, any value of an option cannot be negative because you know that at max option value can go to 0, but it cannot go to negative. That means at any point of time, whenever you are getting an option value, intrinsic value as negative, you need to consider that as 0 because intrinsic value of an option cannot be negative. It can be 0 or positive. So whenever this is coming as negative for this, which means you need to consider intrinsic value is equals to 0. That means here let's put it as 0. So here let's take it as intrinsic value. Intrinsic value is 0. So out of the total option value, if the intrinsic value is 0, then the leftover is nothing but the time value. Time value of the option is total value minus intrinsic value, which is 92.7, which says that at the money is not having any time intrinsic value. 100% of the value is just the time value. What is time value? Time value means now this option has 4 days to expiry. So Monday, Tuesday, Wednesday and Thursday. Just because the option has 4 days to expiry, now it is having 92.7. This is the value. This will go to 0. At what time? At the end of expiry, this entire time value will have to become 0. Remember one thing, that in options, like time value is the only thing which will always 100% of the time favors the option seller, which means time value means, let's say if the time value of an option is, now it is 92.7, right? This 92.7, the time value, I'm talking about only time value. This time value will always go down like this and it will become 0 at the end of expiry. That means there is no way price can go upside like this. Don't confuse here. This is the premium. Premium can go upside. Maybe it can go to 100, 200, 300. It can go. But I'm talking about the time value. This is the time value. Time value will go down. Maybe depending upon the market momentum, if let's say tomorrow if the market goes upside, this at the money value, what it will have is, it will have 92.7 as time value and it will have additional 100 rupees. That 100 rupees is not time value. That is called intrinsic value. If the market moves upside, it can get some intrinsic value, but it won't get the time value will never increase. Now it is 92.7 means always it will go down, keep on going down. And at the end of expiry, it has to become 0 only. There is no way that 92.7 time value will go upside. That is why option sellers know that always time decay will favor them. Most of the option sellers will make use of this time value as an advantage for them to make money in the market most of the time. But of course, they also need to earn like Delta and Vega as well to make more money. But sometimes Delta might work in their favor, sometimes it might not work. Vega also sometimes it can work, sometimes it cannot work. But Theta is the only thing which will always favor the option seller because it will bring down the value as and when the time is expiring. And as a buyer, remember that always a buyer wants the price to go upside. They want to purchase at a lower value and they want to sell at a higher value. Seller will always want the price to go down. They want to sell at a higher value first and they want to square off at a lower value so that the difference is profit. Always both are thinking oppositely. So whenever the value is reducing, it is good for option seller. Whenever the value is reducing, it is bad for the option buyer because buyer wants the price to go upside. Now, okay, this is 92.7. This is the time value for at the money. Now, let's take it for in the money. 2 legs in the money, we can see. Now, 2 legs in the money is 192, which is 18,200. So, 192. Now, what is the value of intrinsic value? I mean, the formula of intrinsic value, spot price minus strike price. Spot price is 18307. So, 18307 minus strike price. Strike price is 18200, which is 18200. So, now see, intrinsic value is coming as 107. Out of total value, intrinsic value is 107, which means the remaining value, just a second. Yeah. So total value 107 is the intrinsic value. Then the rest of the value is time value. Now 85 is the time value, right? Let's go back and then check it out here. So here, $18,307. Okay, 18,200. $192. So time value formula is spot price, this minus the strike price over here. So if you do this, you will be getting the time value. That should be correct. Let me see. Let's look for this one. 121.2. Sometimes the sensible will not show the proper values when after the market hours. That also I've seen sometimes. But let's see. 18307 minus okay, here the values are not exactly correct, the time values. So don't take this as your exact values now, but remember this formula which is mentioned here. And once the market is open, then you can go and check out this sensible chart, then it will show the correct values. So the time value is, now focus upon these values which I'm mentioning here. In the money, total option value is 193, total value, out of which time value is the total value minus intrinsic value. Remember that option value is divided into two parts. One is intrinsic value, one is time value. Now we are calculating the formula for intrinsic value, which is spot price, whatever the Nifty or Bank Nifty spot price, this minus the strike price, whichever the option that you are selecting. In the money means which in the money you are selecting, that strike price you need to select. Then the difference what you are getting is called intrinsic value of an option. So that is what we are doing here. So here we are selecting 18,200 option value, which is trading around 192. This is the option value. Now 192, we need to calculate the intrinsic value first, which is spot price 18307 minus the strike price 18200, which is 107. Now the rest of the value is the time value. So 192 minus 107, the rest of the value is 85, which means in the money, time value is only 85. Rest of the value is intrinsic value. Total value is 192. Now when you are paying money both for intrinsic value of an option to get it. For the time value also you are paying it. But more money is going to the time value only. Sorry, intrinsic value only. For time value you are paying only 85 rupees. For intrinsic value you are paying 107 rupees. But when you go for at the money option, you are paying 100% of the price only to buy the time, not for the intrinsic value, or not paying anything for this. Now like that, just check out for the out of the money also. OTM means whichever the strikes which are above the current market level, those are called out of the money options. Now here if you see, these are all out of the money options. And one common thing that you can notice in all these options is the both option value and time value is exactly the same. So 68.2, 68.2, 15, 15, 6, everything will be the same because it's a simple fact that all the out of the money option values will have zero intrinsic value. How you can confirm that? Just by using the formula, you can confirm that. So here you can come out of the money. Total, let's take any option value, we can take it. Let's take it this one, 15.3, which is 18,600. So 15.3, and we are going for 18,600, which is out of the money. Now calculate your formula. What is intrinsic value? Which is spot price. So 18,307 minus this one, 18,600. And whenever something comes into negative, I told you that you need to take it as zero because intrinsic value cannot be negative because of a simple fact that option value, you can never see it as a negative value. It can either be positive or it can be zero. So it cannot be negative. So whenever you are getting something as negative, keep it as zero. Now look at the time value, total option value minus intrinsic value. That means there is whenever intrinsic value is zero, complete option value will become your time value. So now you need to understand this basic difference. This is the difference why in the money options are priced much higher than the at the money options. This is at the money option. It is moderately, let's say it's 100 rupees. This is 120, 121, 192, 267. So it's keep on increasing. This one is reducing. Because here as and when you go outside, the premium value decreases. And as and when you go towards the in the money, if you go directly here, it is costing you 1,000. 1,000 into lot size 50. That means you need to pay 50,000 rupees approximately to buy one lot. But if you want to buy here, you are going to pay only 4,000 rupees or something, 4,800 or something like that, you will be paying it. Now, why it is important for us to understand so that we know which strike to select when you are an option buyer. Let's talk from the intraday perspective. You are an option buyer. Let's think that you are a buyer of an option. Now, as a buyer of an option, what you want, if you are buying a call option, you want the call option price to go upside. If you are buying a put option, you want that option price to, that means put option also, when the market goes down, your put option also will go upside. That means all the time you want your price to move upside so that you can buy at a lower level and then you can square off at a higher level. Now you have multiple options to select. Let's say if you feel that next market is going to go upside. So which one do we select? At the money or out of the money or in the money option? Which is better? So let's do an analysis for that. We can also take this into Bank Nifty also. I'll show you so that it will be clear for you. So now you see this is the Bank Nifty also. Same concept, Nifty or Bank Nifty or any particular stock, the concept will be same. So Bank Nifty also, since the Bank Nifty is closed at 4 to 437. So it is taking 4 to 500 as at the money option. And the rest of the whatever is below or in the money options and whatever is above or out of the money options. So let's take this. Now let's say if you are thinking that Bank Nifty will go upside. So what happens is, let's take, okay, now this I showed you, right? Let me go back to Nifty, and then since we plotted the values in Excel, let me use the same thing. It will be easier for understanding purpose. Okay. Here, let's take an example that you are bullish about Nifty and market price is 18,307. You are expecting market to go upside. Let's assume that you took the trade and market went to 18,400. So now, what is the profit that you will be getting? Let's understand this concept. If you bought call option of one person bought at the money, one person bought in the money, one person bought out of the money. So what is the profitability? Let's understand that profitability. So how to calculate that? So when you want to calculate it, maybe you can use this also. So here also you can use this strategy builder to find out what could be the profitability. Now let's go here and then let's buy call. So we're buying a call for coming expiry. Now, let's take this. Let's take rounded off figures. We'll take it. We'll avoid 50 rupees. So generally, because we don't buy 50 rupee options like 18,350, 18,250, 150 like that, we avoid. We try to buy rounded figure. Like we'll try to round it off to the nearest 100 multiple, and then we'll try to select those options. That also we can treat it as in the money, not a problem. Now here, 18,300 option is showing as 121. Let's take it as 121. Now, when I take it as 121, let me again calculate the intrinsic value of 121, which means for 18,300, let me calculate the intrinsic value, which is spot price 18,307 minus the strike price, which is this one. Now I'm getting 7 rupee as intrinsic value, and remaining value is my time value. Let me combine ATM. Let me check ATM in the money, out of the money. So this concept is very, very important. Like if you can understand this, most of the topics will be very clear. Even when you're analyzing the option chain data, this is what is most important. Now let's understand. Market went to 18,400, or let's take market went to 18,500. Market went heavily bullish in your direction, 200 points in your direction. Here it will show the profit or loss value. So now let's keep this as 18,400, 18,400. Now here you can see something which is, let me keep it here. As of now, the values which is showing is nothing but the values as of Friday. So it's assuming the values of Friday, and then it is showing some approximate values. So what we assumed, market went by 0.5% upside from the entry level, which is it went to, we thought of 18,500, right? Yeah, market went 1% upside, which is 18,500. And which option you bought? 18,300 call option you bought, which is trading around 121, and you paid the price of 6,000 rupees. Now, how much profit you will be getting it? See this, it is showing that you will be getting a profit of 6,927, which is almost more than 100% of your investment. You invested only 6,000 rupees. You are getting 6,927. Let me write it here. So 6,927 profit and let's go for in the money, which is 18,200. So let's go here 18,200, and now the profit is 7,875. So let me write it down, 7,875 profit. Let me also write down the cost. Cost means your investment, cost or slash investment or deployed money, whatever you can call it, that you can put it. So for in the money option, how much you deployed? You deployed 9,600. So 9,600 you deployed. And for at the money option, let me check it, how much we deployed. We deployed 6,060, 6,000 rupees. 6,060. And let's go finally for the out of the money, which is 18,600. And how much profit you will be getting it? Let me 18,600 means we have to go upside above the current market level. So like this, which is 15.3, that means you have invested 765 rupees and you got a profit of 2,444, which is 2,444 is the profit, and you have invested 765. So this is the situation, right? Now let's calculate return on investment, ROI. How much you invested and how much money you made if Nifty moved by 1% in intraday basis, not for carry forward position, for the intraday purposes. So here ROI calculation is this one, cost profit divided by the cost or investment into 100. Here you made 114% of ROI. Same formula let's apply here. Here you made in the money, if you are buying, you are making 82% of ROI. Now out of the money, if you buy, you made 319% of ROI. That means 300% of ROI here. Here 82% of ROI, here 100% ROI approximately. Now you may feel that out of the money is giving me more profit for the money that I have invested. So let me directly go for out of the money option is what you may, that's what it's showing here, right? If I go with ROI, that's what it looks like. If the market moves upside, you're going to make more money in out of the money rather than in the money and at the money. But the thing is, we considered in intraday, there will be time decay will be there. That means the premium will slightly decay, but that consideration is not happening here. We are not considering the time value decay here because this particular thing that we are assuming is happening on the intraday basis only. We are not extending day by day. It is exactly on the same day we are doing it. In reality, for every 1 hour or every 30 minutes, the time decay value will keep decreasing. But that effect will not be shown after the market hours. It cannot be shown in the sensible, which cannot say that after 1 hour you can't see. Like you can't say that from 9:15 or 9:20, you can't put the dates a time like that. So this particular thing, first of all, is not taking into account your time value. Time value, if you remember the time value, what is the highest time value that you are paying for? Here I am paying 100% of the money that I am paying is for time. Here only how much percentage, let's say out of 192, approximately I am paying for the time, maybe let's say 45% of the money that I am paying is for time. So let me put it out here itself. Try to understand this, it's very important. So how much money I am paying, money paid to buy time. As a buyer, because you're a buyer, you're not a seller. Remember, we're talking from the buyer perspective. How much percentage of the money that if I'm investing 192 rupees, how much money I am paying to buy time value, which is 85 divided by 192 into 100. 44% of the money I invested to buy time value, not intrinsic value. Here, if you see, out of the money, I am paying 100% of my money to buy time value only. There is no intrinsic value for me. Now, when it comes to at the money, I paid almost like 90%, maybe 94% I paid to buy the time value. So what happens is, as and when you're going out of the money, whatever the amount that you're paying is for the time, not for the intrinsic value. Now, the fact is, as and when the market expires, that means 1 hour or 2 hours or 30 minutes, whatever it is, as and when the market like expires time value will go down because time value has to become zero at the end of expiry. It's not like only on expiry day completely it will come to zero. Time value curve will look like this. From here it will start, slowly it will come, and at the end it will be faster. When it is coming towards the expiry, it will be faster. Maybe it's Monday, Tuesday, Wednesday and Thursday. So by Thursday it will be zero. That means in intraday also there will be some, if you zoom in and then see this, in intraday maybe it can slightly go down like this. As and when the time is expiring, the time value will go down. So in reality what happens is, this 15.3, if nothing happens in the market, then let's say if you bought at 18307 and market is trading near that range or slightly it is going upside to 18,320 and then 350 like that, if it is going, then this 15.3, since you paid 100% of the money, whatever the time which is decaying from this will impact you 100%. That means it can go to 14.3 or 13.3 even during the intraday also if there is no big momentum. Here we are assuming it 1% quick move that we are assuming. But what if it's not like you will be getting like almost 200 points of a move in Nifty as soon as you buy? It's a very rare scenario. But most of the times price can go by 50 points and then come down by 20 points. And then maybe it can go down by 20 points, etc. It will be like that. It is very rare that the moment you buy, the Nifty will shoot up to 200 points like that. So we need to talk the realistic point of view. In that case, what happens? If the time value decays, you are going to get affected 100% here. But for in the money, you are going to get affected only 44% only. Because the fact is, time value will never decrease this intrinsic value. Only the time value portion, whatever is there, that only will be reduced. Now here, 15 may go down to 14.3. That means if you talk from the percentage point of view, let's assume that on Monday, the time value got decayed by, let's say 20%. In that 20%, out of the money, let's say 20% is for at the money. But out of the money, it can be even more. Out of the money, decay can be 30% or 35 or 40 or 45%. As long as you're going out of the money, it will be even more. But in the money, it is lesser. Because in the money, the investment that you are making is not 100%. You're here. Only 50% effect will be there. But out of the money, 100% effect will be there. And for at the money, almost near to 90 to 100% effect will be there. Which means now in this case, we took an example of 18,500, right? Then we are getting out of the money as a good option to buy. Let's take slightly bullish view. That means let's assume that market went to 18,350 only. Instead of going for 18,500, let's take the realistic scenario that market went up by 50 points. Now, let's understand what is the profitability scenario. So here we need to change from 18,500 to 18,350. Now look at the profit. For 18,600 out of the money, it is showing as 339. Yeah. 313 here. $339 is profit for out of the money. This is for at the money, which is showing as 1355. For in the money, let's go to 18,200, which is showing as 1566. 1566. Now again the cost will be the same cost. So the cost will not change. The profit only will change. Now again, let's calculate the ROI. ROI is nothing but profit divided by the cost into 100. This one here, this one here, and this one here. So again, here the thing is, here again, you are saying that now at the money is slightly better than in the money, and out of the money is better than at the money. So here also it is showing that out of the money is giving you slightly higher return because of the simple fact that the time value is not considered here. Because if in case assume that the same if you carry forwarded, then we can account for the time value. That means now if I increase this to, let's say you have carry forwarded it till Tuesday. For example, the same thing you carry forwarded till Tuesday. Now look at the profit is turning into loss because now we are accounting for the time value. Because now there's an option to move from one day to the next day, but there's no option in the sensible to move from 9:15 to 9:30 or 9:20 like that. But during the intraday also time decay will happen. To represent that, I'm just like moving it further for 2 days so that you know how much the time will impact. Now for this one, in the money, you're getting a loss of 910. If imagine that market went to 18,350 and the 2 days got expired, look at the loss. Now you're not in profits, you're at a loss of 910 for in the money. So let me keep it here. Loss, which is in the money, is minus 910. For at the money, what is the loss? The loss is 1347 for at the money. So 1347 is the loss for at the money. Now go for out of the money. Now look at it. The complete picture changes. As and when you want to carry forward out of the money, this is where like people want to buy at a low price and they'll feel that market, if it goes in their favor, they want to make money. Now look at it. They are getting a loss of 661. So which is minus 661. Now let's calculate the loss percentage. Because it's not always about profit, you have to always take care about your loss. Then profits will be a byproduct. So this minus your investment, this divided by your investment into 100. 22% loss you made. Now let's do the same thing here. You made only 9% loss. And here if you do, you are making 86% of the loss. Now, if you look at these three things, in the first scenario, when the market went short up till 18,500, this is giving you 300% of the return. Now, in the second scenario, when the market is slightly bullish in intraday, it is also giving you the maximum return out of the money. But the thing is, in both these cases, we did not account the factor called time value. In this case, to show that like how the time value will impact, we took the time value factor into account because this is nothing but decay. Now I'm moving from one day to the other date. From here, I moved to the next date, just to show you that how the time decay will impact your option profits. Now look at it all the way. Now, neither ATM is attractive nor out of the money is attractive. In the money option is attractive because that is giving you the lowest loss possible, even after accounting for the time. Time is decayed and the market went up by the same 18,350 only in all the three cases. But the least loss you are getting in which one? The least loss will be getting in the money only. Not even at the money is giving you 22% of your premium is eroded. Imagine this way, somebody invested 1 lakh rupees here, 1 lakh rupees here and 1 lakh rupees here. And within 2 days, this person lost 86,000. Because if you want to really understand the impact of it, you need to multiply it into the number of lot size. Treat it as a highest amount, then you will understand the real impact of it. If a person buys out of the money and then within 2 days, if the market moved 50 points in that direction, that person will be losing 86,000 rupees. He'll be left with only the rest of the money if he closes at that point. And for the person who bought 1 lakh, he invested 1 lakh and bought in the money. He is losing only 9,000 rupees. Here he lost 86,000 rupees. Here he lost only 9,000 rupees. And for the person who bought at the money option, he lost 22,000 rupees. See, profits, whether it will move in your direction or not, will actually depend upon the market situation. But the thing that is in our hands is to control the losses to the maximum extent possible. So when you control your losses and then like when you take the trades properly, if it moves, you will be getting profit. But if it is not moving, you will anyways control your losses. To control that particular loss, what happens as and when you go for out of the money, even in the intraday also, this is the same scenario. When you're going for out of the money, the losses will come quicker as compared to at the money, and at the money losses will be quicker as compared to in the money. So with all these discussions, one thing is clear that whenever the time value comes into play, intrinsic value in the money option is the only option which can give you less loss. So people always talk about profit, but it's not about the profit. Profit will come if it moves, but most of the times it won't just like that move. So how many times you thought that like you bought it something and immediately price went like shorting up in your side? That may happen in a lucky day, or some big move can happen. Luckily, you may get money, but that's not the reality all the time. But people will just look into that and then they'll try to buy out of the money options kind of stuff. But the overall point is when it comes to the strike selection, which option should I buy? So as per this, avoid out of the money, because as a buyer, the moment you are a buyer, there is an impact of time value. Even if you hold it for 1 hour or 3 hours or 1 day or 2 days, time value will be there. But let's say if you're just holding it for 5 minutes or 10 minutes, then that impact will not be that much. But as and when you hold it slightly higher, the time value will definitely impact, and that will take away your losses very quickly in out of the money. At the money is still fine. It's not as bad as like out of the money. It is still fine. You may even go for it. But I suggest is if you go for one leg in the money, that is the best possible selection that can happen, because that will give, as a buyer, that will give the least possible time decay. Because remember, as a buyer, only one thing that will impact negatively all the time, 100% of the time, this is the only one thing that can impact negatively for the buyer, for the option buyer, which is nothing but the time. So time is not in your hand. It will always keep on reducing only. So only thing that you can go for is to reduce the least possible impact. Out of these three, when you enable the time value, out of these three, the least impact is happening for in the money option. Again, what happens? So just because in the money is having least, you can't go for deep in the money also. The problem is if you go for deep in the money, the cost will significantly increase. Now it is only 100 rupees at the money. 1 leg in the money is still fine. It is 121, or 2 legs in the money is also still fine, which is 192. But if you're going for deep in the money, you need to pay higher price. When you pay higher price, what happens is your return on investment will decrease. That you can check it out here. When the market is actually moving upside, if you take the ROI impact, here the ROI is more for at the money. For out of the money, it is even higher. But what is the lowest ROI that you are getting here for in the money? And as this is at least 1 leg in the money. But if you go for 18,000 or 17,900, this ROI will decrease to 60% or 50% like that, which means don't go for deep in the money because the cost will increase. When the cost increases, the ROI will definitely decrease, and don't go for out of the money options because the time value will impact. This is from the perspective for the buyer of an option. Even if you're carry forwarding or even if you're intraday, time value will always affect. So most of the times go for one leg or two leg in the money. And in rare cases, if you're doing intraday only, then maybe you can go for like at the money option also, because at the money option is slightly like cost effective than in the money options. In only those cases, you can choose between at the money and in the money, but better not to go for out of the money. That is the overall logic behind this particular thing. After this, same happens for the put also. The entire logic will be same, but when it comes to put options, at the money will be the same. It will be 18,350 only. But for put options, whatever the values which are lesser than the at the money option are called out of the money options, which is exactly opposite basically. And whatever the values which are higher than the current market value are called in the money options. Now here also, what you can do if you are short about Nifty, then maybe first of all try to find out what is the current market price and round it off to the nearest 100 multiple, which is 18,300. Now this has to be treated as at the money because we are rounding it off to the nearest 100 multiple, not to the nearest 50 multiple. Now 18,350 should be your at the money. Then one leg in the money is this one, 18,500. Yeah, 18,300 means it will be 18,400. This will become your one leg in the money option. Even you can go for, if you're having slightly better capital, you can even go for 18,500 also. But avoid going for 18,200 or 18,100 because they form part of out of the money options. If let's say if you're doing scalping, that means you are holding the trade for maximum 5 minutes or 10 minutes. In that case, you can go for at the money option also, not a problem because like time value impact will not be that much. But when you are maybe, especially when you're carry forwarding, never go for out of the money. Maybe you go for one leg in the money or at the money. In intraday also, if you're not very sure, like you may hold it for 1 hour or more than 1 hour, then go for like in the money rather than at the money or out of the money. So this is a basic concept. Again, like we don't have all the time to discuss everything because we just discussed only one topic now. Let me move on to the remaining topics. We just have 1 hour, 15 minutes more. So I'll be like, it's not like I'm explaining it from the very basics. I'm assuming that you will be having some knowledge on the options so that whatever is already explained on the post, I'm trying to like decode it to the extent possible. Okay, now the topic is this one, strike selection topic is done. I will go for how to understand the option chain. So this is the same option chain that we're checking now. So where is the option chain? Yeah, this is the option chain, right? Now, so till now, so this is also an important topic. These two topics will be the base to understand like the option buyer and seller perspective. Now we got an understanding of option buyer. Let's quickly understand how the option seller will think. For that, let's take a quick example. Let me go to Bank Nifty. And now think this from the expiry perspective. That means a person is buying an option for the thinking to hold it till the expiry. And when a person is buying the option, other person will be selling the option. He also wants to hold it till the expiry. Now let's take at the money option, which is 42,500. Let's say, like maybe you're a buyer of an option. Somebody is a seller of an option. Let's understand if you're a buyer of an option, what will happen. So here you can go. So what is at the money? 42,500 is at the money. So go here, click on Bank Nifty and click on at the money. Automatically it will be at the money only. So click on buy call. So buy call 42, let's go for 42,500. Okay, now this is a buy call that you are doing in Bank Nifty. Now assume that this person is wanting to hold till the expiry, thinking that the market will be bullish. So now this is the expiry date. So now check the break-even level. Break-even level is this one, 42776. What is meant by break-even level? Let me mark it on the Bank Nifty chart. 42776. This is the Bank Nifty chart. 1 hour time frame. 4277 is somewhere over here. Okay. So let me even go to 5 minutes so that you can understand this is where the market closed on Friday. And somebody is buying a call option. Imagine that the market was going upside. So somebody thought that like market can go upside in the coming week. So they bought a call option of 42,500, which is 42,500. So this is the option that they bought. And this is the break even. Break even means at the end of expiry. Now don't think from intraday perspective, think from the expiry perspective. If the market really goes upside this much, if it moves this much, that is how many points? Let's calculate from your entry point to that point. How many points is that? So approximately 340 points, 340 or 350. So if the market goes up by 350 points and expires over here, you will get nothing. That means you are not making zero. I mean, you're not even making 1 rupee profit, even if the market is going and then expiring over here. So why is that happening? Because there is a concept called, so you need to first of all recover your money. How much you paid for this? You paid 6,919. 6,919 you paid. First of all, you need to recover the 6,919. That means you need to get 6,919 as your money. Then whatever you are able to generate after that will become your profit. Because if you are putting out this money, obviously you need to get back that money, and on top of it, if you are getting 1 rupee or 2 rupee, that is when the profit will start happening. Otherwise, like profit, like you won't get profit. So now in this case, what is happening is, now look at this. If the market actually went up to, so what is our target? Which let's take it went up to 4277, or let's say 4277. So let's assume that market went to 4277. Now look at the profit that you are making, exactly break even. So it's showing as plus 15, which means almost break even. You are not making any money, even if the market is moving up by 1%. So why that is happening is because, so now this particular thing will have something called as a time value. Now, what is the time value of that? Let's go here and then check what is the time value. 271 rupees. 271 rupees is the time value. Let's say 271.45 is the time value. Now, let me open Excel. So let's focus here. 271.45. So you paid 271.45 rupees to buy time. Now what happened? This, whatever the value that you are getting here, right? This value will 100% go to zero only. There is no other question about it, which means this 271.45 will become zero. So this one will become zero, and you will be getting a loss of 271 minus 0. This one into Nifty lot size, which is 25. 6786 is the sure shot. Like that is nothing but your cost only, that much you are paying approximately. So this will go to zero. Now, where you will get profit then? If this is the loss that you are making, then this is a time value. Now, let's come to the intrinsic value. Now, intrinsic value, how much amount you paid? So now calculate this. Out of the total 276.75, you paid this much for time. That means you paid somewhere close to 5 rupees or something. You paid for intrinsic value. Let's take it as 5 rupees. 5 rupees you paid for intrinsic value, right? Now, at spot price is, what's the spot? 42437 is the 42437. This is the spot price now. But what we are assuming that market went up to what level? So we are assuming that market went to 42,777 on the expiry day. So that means market went to 42,777. Now let me calculate the intrinsic value of an option at the end of expiry. Now this is what we are talking about, expiry date. What is the option which is spot? What is the formula for intrinsic value? Spot minus expiry. This is the spot price, which is 4 42,777. That is the spot on the expiry day, not on today. We are calculating the intrinsic value on expiry day. Minus the strike price. What is the strike price that I selected? 42,500. That is the strike price, right? Let me check it out. Yeah, this is 42,500. That is my original strike price that I have bought. Now look at it. I am having 277 rupees as intrinsic value. That means my 5 rupees has went up and gave me 277 rupees. Now calculate the profit. This is what my buy price for intrinsic value. And it went up all the way to 277. That much, how much profit I am making? 277 minus 5. So intrinsic value is giving me a profit of 272 and time value is giving me a loss of 271.45, approximately take it as 272, which means now you know that time value is giving me loss. You know that before itself, time will always give you loss. But your bet is that as a buyer, you are betting on two things. I mean, time value, you are putting money to buy the time. You are putting money to buy the intrinsic value. Time value will definitely go to 0. You are betting that 5 rupees of intrinsic value you are buying, right? That you are thinking that if Nifty goes upside, I am getting this much. If Nifty goes to, let's say, 2,877, then you will be getting intrinsic value of 377. You will be getting more profit. Let's take this example only. This 5 went to 277. You made a profit of 272 rupees in intrinsic value. And this entire time value, you always know that it will anyways go to 0. So it went to 0, minus 272, plus profit here and loss here. If you combine both of them, what is left out? 0, which means that is the break-even point. That's how the break-even point is calculated. At 4, if the market expired around 4,277, you are neither going to make profit, you are not going to make loss. You are just breaking even. Nothing like you are losing nothing. You just have to pay the brokerage. That's the thing. That is how the break-even point is calculated. So if you want to calculate the break-even point, the simple calculation would be, so this 276.75, right? This is the premium. So now for strike price plus premium. So 42,500 plus the option premium, if you add, you will be getting the 42776. That is called as a break-even. So whenever you want to calculate the break-even point for an option buying purpose, to the strike price, add your premium value, you will be getting the break-even level. But inherently, this is the logic behind it. Your time value will go to 0, but your intrinsic value will go upside if the market is moving upside. So result in giving you no profit, no loss. But if the market tend to be sideways, it is not going anywhere. Let's imagine that market was exactly at the same place. Now what happens? Let's understand very quickly. Now market did not go anywhere. Then what happens? Look at it. Time value will anyways go to 0, that you already know, because time is expiring and this is giving me a short loss. Now market is now itself 5 rupees. Intrinsic value you paid 5 rupees. At the end of expiry also it will be 5 only, because the same spot price is same and strike price is same. Both are same. That means this is giving you 0 profit. That means whatever the intrinsic value you paid for, that is the only thing that is left out. Out of the total option value, 276 rupees that you paid, 5 rupees is left out. Now remaining everything is loss for you. That means 5 rupees, or let's say 272 rupees is loss for you. And what is your total investment? 276.5 something. That means 99 into 100 if you do, you are getting a loss of 99% almost. What is that 1% which is left out is nothing but whatever you paid for intrinsic value, that is still with you, because intrinsic value, the time decay will never happen. Time decay will not impact the intrinsic value. Now look at it. Here also it is showing the same thing. You will be losing 99% of your money if the market is not moving anywhere. That means imagine market is neither going down nor going upside. Still you lost 100% of the money you lost. Imagine somebody bought for 2 lakh rupees thinking that they're going to become a rich person. So 2 lakh rupees they bought and then they lost everything. 100% of the money has been lost. So people underestimate like option, like this. They think that option selling is more riskier. But can you imagine that you are putting your 100, imagine whatever the capital that you have, if you are investing in this particular thing, obviously here also there is a possibility of you losing the money entirely, right? 100% of the money you're going to lose, even if nothing is happening in the market. And not only that, the worst case scenario is, even if something happens, let's say even if the market is moving up slightly higher, it went up by some few points, let's say 100 points or 50 points, still you're going to lose 90%. Let's say it went up slightly even higher. Now you're losing 50%. That means it has to move certain amount for you to break even only. Below that and all, it will be loss. If it goes above this level, obviously you will take profit. But many people will only look for this one. Okay, if it goes upside, I'm getting too much of a profit. But they are not worried about market. What if the market is sideways? And what if the market is neutral? And obviously, if it is bearish, you are anyways going to lose 100% of your money. That is also there. Now, by default, what happens is, options is a zero-sum game, which means if you are buying something and if you are getting profit, the seller will be getting the loss. Now, in the same case, say somebody is asking what happens if you are buying out of the money option. The same thing, right? Like if you're buying out of the money option, you're going to lose 100% of the money even, because our assumption is market expires around 4 to 777, right? Yeah, now, yeah, no profit, no loss. Now this is at the money option, right? Let me go for out of the money, which is 17. Let me go for 42,800. Now you lost, not break even. It is 100% loss for you, because I told you out of the money options will have the highest time decay. Now what happened? Your investment was not there in the intrinsic value anyways. And whatever you paid for is only time value. Time value is becoming zero, because you know that time value will anyways go to zero. Because intrinsic value to grow, it has to go beyond this market. For you to get profit from intrinsic value, the spot price should be more than your strike price. But in this case, your strike price itself is 42,800 and spot price is lesser than your strike price. So there is no intrinsic value benefit. Only benefit that you might have is time value. That means if you exit earlier, you may get with a lesser loss. If you are holding on to it, you will be getting the 100% of the loss. You have to face it. This is if the market slightly goes upside, but if the market is neutral completely, you're going to lose 100% of your money. When you will be making profit, if you're buying out of the money option, means if market closes, goes beyond this level, beyond the break-even point. That means let's assume that market went to 43,000. That is the scenario where you may make some profit. So now you see you made a 42% of the profit you made. That means if the market went up by 1.3%, then you will be making profit at the end of expiry. Even before expiry also, you can make even more profit, because the time decay will be lesser till 2 days. And as and when you go forward, the time decay will be higher. That means if there's a momentum, good move, then out of the money options will give some good profit. But if there's a slow momentum, then the time value will be faster to decay and your intrinsic value will not come at that point. Intrinsic value benefit will come only if the market moves beyond your strike level. Then only you'll start making the intrinsic value benefit. Otherwise, there won't be any benefit for the intrinsic value. So that is the thing. So options is a zero-sum game, which means that some are asking for recording. Recordings we're not very sure. Like we need to see where we can share it and all that. Yeah. So options is a zero-sum game, which means if an option buyer is making profit, option seller will be making loss, and vice versa. Now in this case, now you see, if you are buying at the money 42,500, even if the market is sideways, you are going to lose money. If it is slightly bullish, still loss only. If it is bearish, of course, 100% loss. If it is at break-even level, you're getting break-even, no profit, no loss. If it is going beyond that, then only you're making profits. Which means, understand, in a typical scenario, this is a break-even, right? The market, what all can happen is, market can go in 5 different directions. One is, we can't say in which direction it can go with 100% certainty. One is market can be slightly bullish, or markets can be heavily bullish, or markets can be sideways, market can be slightly negative, or markets can be heavily negative. In all these cases, only in one scenario, the option buyer is going to make money. That is in this scenario. That means the market has to break beyond the break-even level and then go upside. Then only the buyer will make money. In rest of the cases, even if the market is expiring here, loss. If it is expiring at the money, it is also loss. If it is slightly going down, then loss. Here also it is loss. So by default, if a person is buying an option and carry forwarding for the expiry, this is still at the money only. We are not talking about out of the money. That will even have lesser probability of winning. Even if you take at the money option, your default probability of winning is 20%. If it has to break and expires above this level, then you will win. That means by default, buyer probability of profit percentage is 20, which means the loss probability is 80%. And for the seller, it is exactly opposite. Because whenever the buyer is losing money, the seller will be making money. So for the seller, probability of making profit for the same expiry, for the same strike price is 80%. Because if this person is making if this person is making loss, profit 20% of the time, then the seller will be making loss 20% of the time. Now, in this case, if buyer is making loss 80% of the time, then seller will be making profit 80% of the time. Because as a seller, what is the advantage? Even if nothing happens, the time value will anyways go down and that person will get benefit. That means if the market is exactly sideways, forget about delta or vega or anything, the time value, whatever the option value, let it be 1,000 rupees. If it is the total value of the time value of the option, this entire 1,000 will go to zero. That means time value benefit will be there completely for the option seller. Unless and until stock moves heavily. If it moves heavily, what happens, for the seller, I'll tell you, for the seller, he'll make a profit to the extent of time value. Maybe that 1,000 rupees profit, 1,000 points he can make to the extent of time value. Profit will be there. That is short profit. But if it trends so much heavily, intrinsic value benefit will be so much higher for the buyer. Whenever something is beneficial for the buyer, it is loss for the seller. That means the intrinsic value benefit will be much more than the profit. Intrinsic value loss that the seller has to face could be much more than the benefit that he is getting from the time value. Whenever that happens only when the market moves heavily in the buyer intended direction. In that case, intrinsic value loss will be more for the seller. There is unlimited because market can go at any point. There is no defined limit to that. Downside, maybe there is a limit, but upside there is no limit. So option value at max can go to zero only. But upside value, we can't say it can from 100, it can go to 1,000 also. So that is the risk. People will say that. So we don't know till what level the option price can increase. So option seller will always hold a risk, saying that there is no defined, if you see here from the selling perspective, this is the chart of seller. If the market is sideways to bearish or slightly bullish, he will make money. But if the market is keep on going upside, the loss will keep on increasing. So that is why people say that there is an unlimited loss for the option selling. But of course, that's also not true because maybe let's say tomorrow you can get out or maybe one day before expiry, you can come out of that particular thing. And the best part is every day, as and when the time is coming towards the expiry, if the market is not moving heavily, you can see that you are making profit due to time decay. So now from here, if I go to Tuesday, you are making 3,500. If I'm going to Wednesday, if the market is not moving anywhere, you are making 4,700 rupees of a profit. Like that, if the market expires and if the market is not moving anywhere, you're going to get 100% of your profit. So whatever the total investment that you made, so here, so maximum profit is 6,919, almost like you'll be getting the 100% of profit over there. But the thing is, seller will put more money. As a buyer, you just have to buy by putting a money of 6,000 or 7,000 rupees. But the seller, look at it, it is asking for 1.46 lakhs of, just to sell one lot, somebody is investing 1.46 lakhs. and that person is having a limited profit, unlimited loss, to say theoretically. So why a person will put so much of a money just for a very limited profit and undefined loss? They don't know if, let's say, tomorrow the market gaps up with a huge gap up, this person will get a huge loss, right? So why the people are taking that much of a risk and then putting out so much of a money, still ending up with a limited profit? Because they know that that is where there's a highest probability of winning. Of course, going naked options, carrying it forward by selling is also not a good idea. You need to have multiple different strategies. There are 20 plus strategies that you can design in a different scenarios, and whichever is suitable, you need to take that. But only one problem that is there for the option seller is undefined loss in case of a huge gap up or a huge gap down scenarios, where there is a possibility if you are not having enough range, you may end up making losses if you don't know how to adjust. And for some small gap up or a gap down, you can make some adjustment. But if the gap up is, let's say, more than 2.5% or 3%, in those cases, it becomes difficult for a person to adjust, because gap up or a gap down will not happen. Like, it will not happen during the market hours, right? So there is no option for you to make the adjustment. In all those scenarios, option sellers may have the probability of making loss, provided they have enough range. But in rest of the cases, they can make good money due to theta decay if they are having enough range in the market. So one of the best example is, you sell out of the money call option and you sell out of the money put option. Then it comes to short triangle, it will become. And then if you go even out of the money, but as and when you want a bigger range, you need to go for both put out of the money and call out of the money. Then you see that your range is getting increased, which means that if the market is going upside and expiring, or if the market is going downside, or if the market is sideways between these ranges, every day you will keep getting some decay. Theta will keep on decaying. Whatever the time value that you pay for, that will keep going to zero. So in these cases, even if the market is moving on any side, because what is the three possibilities are there? Market can go upside, market can go downside, market can be sideways. If you want to make some decay in all the three scenarios, then you have to choose the short triangle. This can be applied when you don't have any perspective towards the market. You don't know where the market can go, because in reality, nobody knows where the market can go. Somebody might think that it can go up, but it can go down as well, right? So that is where this strategy will come into picture. But if you see the risk, what is the risk of this? The capital is slightly higher, and the undefined risk. What if market suddenly gaps up by, let's say you deployed it on Friday, and imagine on Monday, market is making a gap up of 2%, 2 or 2.5, something like that. So in that case, suddenly the moment the market opens, you're going to get a bigger loss. This is not in your control. The moment the market opens, you have two chances: to make an adjustment or to exit. If it is hitting your stop loss, you have to exit and then come back. Now look at the risk reward. Profit is only 2,300. That too, if you wait till the expiry. But the moment market opens with 2.5% of the gap up, you're getting a loss of 7,900, 7,000, something like that. What if after the market opens, if it continues to 3%, you're going to get a loss of 12,000. That means, like, look at the risk reward ratio. It is not even matching, right? Your maximum profit itself is 2,000. Why you are making a loss of 12,000 rupees? That too, it is not in your, that gap up is not in your control. So this is a downside of option selling, where it's not that all the time you'll be making profit. Most of the option sellers make money when it is near to the expiry. So when it is almost close to expiry, if it is within a range bound between their range, then they can make money. But in rest of the cases, it is difficult to manage unless, like, you know how to make the range creation and how to make the live market adjustment, even the positional adjustment, which means there are shifting or extension kind of adjustments can be there, which you need to track every day market and then see if any side the range is getting lower, and you need to shift or adjust or do the extension or do some other adjustment kind of stuff, so that you don't have to face this kind of a major loss. But of course, that is again like a long concept. But overall, the thing is, option seller will have that kind of an advantage. So then what happens is, whenever you're looking at the option chain data, you may see that on call side, at some value, at some strike price, the open interest can be huge. And on the put side, at one strike price or two strike prices, the open interest can be huge. which is nothing but whenever you see the word open interest, which means the 38 lakhs contracts have been opened, that means have been bought by someone and have been sold by someone. When there are both buyer and seller together, then only the open interest will happen. So now 38 lakhs of contracts have been bought, but we should never think the option chain from the buyer perspective, because buyer is investing only, let's say 6,000 rupees. The seller is investing almost 1.2 lakh rupees for the same option. That too, even after knowing that he is going to get a limited loss and undefined loss, undefined loss and limited profit. So they are investing huge funds. Let's say if for 38 lakhs into 6,000 rupees is how much, and 38 lakhs into 1.2 lakhs is how much. That many crores are being invested at this particular strike level. And when it is, imagine if this is an expiry day on 24th November and market, if this is the market, and let's say the market opened somewhere over here, and this is the 38 lakhs of open interest, let's assume that, then when the market is going upside, what can happen is the sellers who are present here, they don't want the market to cross this particular level, because if it crosses and expires above this, the sellers are going to make a huge loss. The buyers will make some profit. So what they'll feel, they'll try to push down the market to an extent. Maybe it can give a breakout, but it can reverse again and then come back within this particular range where there's a highest open interest. In those cases, what can happen? The seller can be profitable and buyer will be losing money because it is closing within the seller's range. If it is closing within this particular range, the buyer will lose money and seller will make money. But this kind of a momentum or like a trend reversal in the market is not possible just for the retail people. When there are huge funds that are involved, when there's a huge selling pressure that is created, that is when there is a slight possibility. That is also not 100% certain, but there is a slight possibility for the market to come back and then expire within this range. What is that range? Whichever is having the highest open interest at the end of expiry date, not on today or not tomorrow, on the day of expiry. So whichever is having the highest call side open interest can act as resistance. It's not that it won't break this level. Maybe it can break if the buyers are strong enough, but most of the times there's a possibility for the price to come below this level and then expire. Same like that, whenever there is a highest put open interest, which indicates a support level. Because as a buyer, you want the market to go down as a put buyer. As a put seller, you don't want the market to go beyond this level, because in that case, as a seller of a put option, you will be making money, losing money. So always the put sellers will try to make sure the market expires above this level. The call sellers will try to make sure the market expires below this level. So that is when the highest put side open interest will act as a support. The highest call side open interest will act as a resistance. That's why you generally keep on listening that resistance and support based upon the open interest contracts. But the main thing is always study the open interest from the selling point of view, not from the buying point of view. So that is one topic. And so these two topics are something which you need to think from the buyer and seller perspective in deeply. Then these things are very similar. Now we also discussed about the difference between option buying and option selling to an extent. It's not within 2 hours, obviously I can't explain each and everything in detail. Also now at the end I'll be taking the Q&A, but in between if I take a Q&A, the session will extend for more time. That we have all other topics to discuss as well. Now last 30 minutes I'll open it for Q&A. Now let's discuss how to keep the stop loss in options. This one also I have shared you. I've shared this post, how to place the stop loss in intraday option buying. So there are basically two ways. First way is, let's say you are having your strategies and then you have, let's say, went long here, for example. So you want to go, you went long here and then you put your stop loss here. Now, this is what you have done it in the spot chart, depending upon your price action skills and your analysis. First, you have to calculate first you need to mark the stop loss in the spot chart. Let it be Nifty or let it be Bank Nifty or let it be any stock option, whatever it is. First, open the spot chart and then try to mark the entry level and the stop loss level. Then try to see below which candle. Now, since you are, let's say you are going for a call option. Now see below which candle this stop loss is there. Now you can see that on that particular day, this is the nearest candle to this. What time it is? This is the 5 minutes time frame. So this time is 1:55 candle. Now what you need to do? Let's say you're going for at the money option. What is at the money option at that point of time when you are entering the trade? Market will be somewhere over here and you may be going for 42,300. That is the nearest 100 multiple. That will become your at the money. Let's say 42,300 is the option that you are selecting, option you bought, call option. Now you need to open the chart of 42,300. That will also look almost like this only, somewhere like this only, because that is at the money option, and that will also move as per your spot chart only, especially when it is at the money option. Now there you will open, and there the pricing can be different. Let's say it can be 200, it can be 190, 170, 160, and 210, 220, like that. The pricing can be there. In the options chart, you can't see it in the trading view platform. You need to check your broker platform only. So whichever broker that you're using, you open the chart from the broker platform. There you first go to that 155 candle. So 155 candle you may identify somewhere over here or anywhere. Let's say if it is here like this, then you will first place your stop loss just below this particular level. You will place it. Let's say if it is at if the 155 candle is at, let's say 165 is the value, then first you will place few points below this. That means you are just keeping it below this. You will draw a line. Then for Nifty, I prefer to give 10 points as a buffer points. From here, you need to put out 10 points. That means from 165, whatever, let's say 160, if you are putting 10 points as a buffer points, which will come to 150. Now your SL will be 150. That means you will be, your buy order will be executed at 200. Now your stop loss you are putting at 150, which means how many points of a stop loss? Stop loss points is 50 points. You are keeping it as a stop loss. 200 minus 150. 50 points means how much amount that you are risking? 50 multiplied by the lot size. So whatever the value that you will be getting, so it will be 2. Yeah. So 50. That calculation how you need to do is, let's say if you're having a capital of 1 lakh and when you're trading in options, now this stop loss is asking you 50 points into 25, one lot. It is asking you 1,250. Now, how much is 1,250 out of your total capital? Into 100, which is only 1.25%, right? 1.25% is fine. Like till the time it is below 2%, it is still fine. Which means out of your capital, you are risking only 1,250. You are not risking, let's say, you are not risking 4,000 rupees. Till what extent you can risk per trade in intraday is till 2%, which means till 2,000 rupees, you can risk it, not a problem. Till 2,000 rupees means what? 2,000 divided by 25 is the Nifty lot size. That means till 80 points, sorry, Nifty lot size is 50, Bank Nifty lot size is 25. So if you're doing in Bank Nifty, and if your capital is 1 lakh, and if you're risking 2%, you can risk up to 80 points. That is maximum. It's not that you need to risk that much. That is the maximum that you need to risk. But how do you place the stop loss? For that, first you need to know the price action techniques, and then you need to identify what is the previous swing low or support level. And then you need to mark the proper stop loss in spot chart. Then once you replicate the same thing in the options chart, just from that level, add 10 points as a buffer points. So in Bank Nifty, I suggest to add 20 points as a buffer points. But in case of a Nifty, you can take 10 points as a buffer points. So in this case, what will happen? Instead of 50 points, it can become 60 points. That is still within your risk of 2,000 rupees. So even if you are going for 60 points stop loss, because I can go till 80 points as per your risk management. So still that point, if it is within 2%, you can go ahead and then place the stop loss over there, especially if you're a buyer. If you are a seller, then also it will be almost same. Like even if you are selling a naked option, that also people will do. to avoid the decay, time decay. So if you are a seller, then you will be selling a put option. When you feel that market is going upside, you will be selling a put option. And if you are a seller, directly go for at the money. There is no need to even go for in the money or out of the money. You can straight away go for like at the money option and then sell it out. And stop loss calculation will be the same. Now, let's say in this case, you are selling a put option, right? So in put option, it will be reverse. Like market, if the market is going up like this, put option will be going down like this. So it is going down means that is good for you because you are selling here and you will be squaring it out somewhere over here and your stop loss will be somewhere on the top side. So just like that, you need to reverse the chart and then you need to find out which candle that you are choosing. And in the put option also, you need to open that particular time frame candle and put the stop loss above that particular level. If you are doing selling of a put. So like that, you need to, that is one way by using the chart. Second way is the delta based method. If you know the delta of the option, which means now if you go here in Sensible and then enable something called as a delta. Now see here, now let's say you're buying 42,500. Now the delta of the option is coming as 0.51. So 0.5 is the delta, right? Now 0.5 is the delta and so whatever. Now what you need to do is, let's say you bought an option which is around 200 and you put a stop loss in spot chart. In spot chart, first calculate the stop loss points. Now it is coming as how many points? You need 120 points. Here you can see, right? 124 points it is coming. Now you will take that value 124 as per spot chart. Number of points of a stop loss 124, multiply that into the delta value of the option that you are buying, which is 0.51. Now you are getting 63 points as a stop loss. Add 20 points to this plus 20 points. Now you are getting the stop loss somewhere close to 83. You can round it off to let's say 80. This will become your stop loss if you are following this strategy as per the delta method. The stop loss point somewhere approximately close to 80. If you are following, let's say, this method, maybe you will be getting this one. We took an approximation. This is not as per the real chart. This is as per the approximation figure that we took. So in this case, let's say you're getting a stop loss around like 60 points. Now in this case, approximately around 80 points, you will be getting it. But this value also we are taking as an assumption basis. But these are the two ways. One is the delta based and one is the chart based, option chart based. In both the cases, you need to add a buffer points. That is suggested. If you are buying the option, then only add the buffer points. If you are a seller of a naked option, then there is no need to add the buffer points. Buffer points is just to make sure to avoid that time decay. Whatever the time decay happens, right? We are just tackling that time decay in a better manner by giving a buffer points. So that even if the price slightly comes down because of the time effect, our stop loss has some buffer points and it won't get triggered easily. If you're a seller, no need to add the buffer points. Directly go for a naked put option selling or naked call option selling as per your direction. In that cases, whatever, without adding buffer points, whatever the stop loss that you will be getting, that is the stop loss that you can keep it. Yeah. One delta means it will be there for the deep in the money options. We'll have one delta, which means, so what is meant by one delta and 0.5 delta means very simple. Let's say there will be, you need to multiply this delta value into the lot size, which means if you are doing in Bank Nifty, you need to multiply it into lot size. Now look at the lot size, which is 25 for the Bank Nifty. Now, if you are going for deep in the money, you will be getting 25 rupees as delta, not more than that. It cannot be more than the lot size value. Maximum it can be 1 into delta value. So it is 25, right? Which is saying that 25 into 1 lot, which is 25 rupees, which is nothing but if Bank Nifty moves by 1 point upside, you're going to get a profit of 25 rupees. For every 1 point upside move in Bank Nifty, you are making profit of 25 rupees per one lot. If it is for 10 lots, you need to multiply 25 into 10. It will be 250 rupees of a profit for every 1 point upside move in the Bank Nifty. Obviously, for every 1 point downside move in the Bank Nifty, you are going to get a loss of 25 rupees. That is what is called the delta value. So at the money will have almost close to 0.5 delta all the time. So 25 divided by like 2, if you do, it will be 13 or 14, something like that. 13 or 13.5 can be. So 13 into one lot, which means if the Bank Nifty moves up by 1 point, you're going to get a profit of 13. If the Bank Nifty moves up by 100 points, you're getting a profit of 1300 for one lot. That is what the delta says. Delta stop loss is very simple. First, you need to calculate, first you need to enable, put the stop loss in the spot chart, and just let's say if you're keeping the stop loss here, now calculate it. Look at this value. It is coming as 144, right? Whatever the stop loss that it is showing here, you multiply that value into the delta value. So 144 into whatever the delta value that you see. If it is for out of the money, it can be 0.4 something. If it is at the money, it can be 0.5. Let's say take at the money. So at the money, it is 0.5. So 144 into 0.5 is coming to 72. Ideally, you need to add 20 points as a buffer points if you are a buyer of an option. If you're a buyer of, let's say, call option, that means if the market is going up, you want to enter, then you can add buffer points like this. Now, sorry, this one you need to add it. So this will be your stop loss, which means from where you have entered. Let's say if you're entering at 200 of your option premium that you bought at 200, then SL will be 200 minus 92. These are just like approximation figures that I'm taking it. So if this is 144 points is what your stop loss is, ideally a bigger stop loss. So, but to be on a safe side, you need that much of a bigger stop loss. You need to keep it. Otherwise, like you may also just like that keep it over here and all. But the thing is, many of the times it may touch your stop loss very quickly and then go in your direction. To avoid that only, we need to have a clear cut is a delta based stop loss or the stop loss as per the spot chart. These two things are available. Okay, so let's talk about the last topic and then I'll be taking a Q&A. So we covered time value, intrinsic value, how to understand the option chain, how to keep stop loss, option buying and option selling is also covered. And so logic behind expiry day strategy, which is we do shared one strategy, which is expiry day. Yeah, here it will be. So on the pinned message, if you go and check it out, so there is an expiry day strategy, which is expiry day butterfly strategy, which is the option selling strategy, which is suitable only for the expiry days. Now look at it, what it is saying. So this one between 9:20 to 10, you can deploy at whichever the time possible, depending upon the experience, you will get to know that. But let's say you choose to do it at 9:30. What you need to do, you need to sell 2 lots of at the money call option and buy 1 lot of in the money call option and buy 1 lot of out of the money call option of equal distance from at the money, which is, let's say if I have to create that in Sensible, let's imagine that today is the expiry day and then you are creating that in the Bank Nifty and market is around 42, around 9:30, the market is around 42,437. So what is the rounded off at the money price? You have to round it off to the nearest at the money, which is 42,400. Now this will become at the money, right? Then you have to go for build custom strategy. 42,400, you will sell call option. How many lots? 2 lots you will sell first. Then look at this one. Look at the value. It is showing as 322 rupees is the value. See, whenever this value is somewhere close to 320 or 325 like that, that means if it is if this value is somewhere close to 22 or 25 like that, round it off to the below one. Now here you can round it off to 300. If it is, let's say 350 or like that, then round it off to the next one, which is 400. So now in this case, if it is 322, you round it off to the 300. What is this 300? This 300 says that from this level, you have to go 300 points upside and then buy one lot of call option. And from this level, you have to go 300 points downside and buy one lot of call option. So let's do that. 1, 2, 3. Let's buy one lot. And from here, 1, 2, 3. So here you sold 2 lots of call option. And depending upon this premium, you are rounding off that premium. And if it is 300, you are going 300 points upside. Let's say on expiry day, the values will be a little bit lesser. Now it is 300, but obviously on Thursday, that value can be somewhere close to 120 or 150 like that. In that case, you can round it off to the higher multiple, which is 200. Then you will be going for 200 upside and 200 downside. Now, when you do that, you will be getting something called as it looks like a ironfly, but it's not ironfly. It is called as a butterfly strategy. There is a much difference between the ironfly and the butterfly strategy. Now, this is called as expiry day deployment. This is the deployment. Now, what can happen? The benefit of this particular thing is, let me tell you the benefit. On expiry day, that is the only day, like market will, like the premiums will, time value will go to 0. There is no other day that we can extend for. The benefit, what can happen here is, if let's say the market went up by 0.5%, look at the profit or loss. You're not getting any loss, even if the market is moving by 0.5%. So for example, if market went up 0.5, you're not getting any loss. It's almost at a break even only. But let me tell you, if instead of this, if I do this is looking like an ironfly, right? Let me do the same thing for the ironfly. Let me go to the strategy builder. And instead of this, if I deploy iron butterfly, this is how it will look like. Now, I'll do the same thing. If the market goes up to 0.5 on this particular day. Now, if it is going to 0.5, now I am facing some small loss. Even if it is slightly loss, both are losses only. But look at here the loss is almost close to 26 rupees. Here the loss is close to 270 rupees. So what happens in case of iron butterfly and ironfly and this call butterfly strategy is, here the loss and profit will not be very quick. Profit also you will not get quickly. Loss also you will not get quickly. Even if the market is moving up or down, it will be almost neutral only. Mostly the call butterfly will give you profits. It will start giving you profit after 1 p.m. or after 2 p.m. Then what happens? The delta of the call butterfly will become higher and higher. Then what happens? Let me tell you. This is the range that you will be having it, right? Let's say around, this is the range, for example. Now here it is, let's say 42,000 and 43,000. Now there's 1,000 points of a range. Bank Nifty is, let's say on expiry day, most of the times what can happen on expiry days, markets will reverse most of the times. Now let's take last 4 expiries. What is the date of expiry? Okay, let's take it here. What is the date? Let's go for, which is recent expiry was on over here, right? Okay, look at the reversal. So look at the type of momentum that happens. This was on 17th of November. That V-shape thing, if it is visible, then there is a very much possibility that your call butterfly will be giving the profit. This V-shape thing is important. Now this was possible on this particular previous Thursday. Let's go back to 1 week before. That means the previous to previous expiry date. So Monday, Friday, and this was the Thursday. Look at the V-shape recovery. So this is a V-shape. So this, whenever this kind of a V-shape comes now, then there is a probability that your call butterfly will be giving you a good profit. That to look at like move. That to especially in the afternoon sessions you are seeing it, the recovery. And again, let's go back to Thursday, right? And the previous Thursday would be Wednesday and Thursday. So here what happened? The V-shape recovery was not completely, like it was not completely towards this opening level, but there was some kind of a recovery that happened around this area. So there are two ways to manage this particular thing. One is by doing adjustment. One is by not doing adjustment. Adjustment is a difficult or slightly complicated process wherein you need to move it little bit. You need to either when the market is going up, you need to calculate the delta value, and then you need to sell put option. If the market is going down, you need to calculate the approximate value, not based upon the delta. Sometimes we also look at the premiums that is trading at that point of time. And if the market is going down, you need to sell a call options approximately to that particular value to match that particular value. But we don't talk about that now. We talk about without doing adjustment. What happens is, let's say around 9:30. So what is the time here? Before 10 o'clock, you can do. Let's imagine you did it at around this area when the market is. My suggestion would be, whenever you see a complete big bull candles, don't deploy that at the beginning. Don't deploy at 9:10 or 9:20. I mean, like 9:20 or 9:30. Don't do that. Wait for some pullback, some consolidation before 10 o'clock. Try to deploy around that area. Whenever you see complete range candles, no, don't deploy immediately at 9:30. It is not exactly time-bound strategy. It is better to wait for some quick pullback. Then you may do it. That works better rather than jumping into the trade at a specific time. Now, what happens is, if you deploy here, you have a range. This range will be there. So if at any point of time after 1 p.m. or after 2 p.m., if the market is coming back into this range, even for 1 minute, that means after 2 p.m., if the market is there inside this range, even for 1 minute, you will be getting a good and decent profit, which can, that means 1:1 or 1:2 or sometimes 1:3 is also expected. That means as and when it is coming closer towards the 3 p.m., your profit potential will go upside. So remember one simple thing, from whichever the point that you deploy, you will have some range like this. Before the market, after 2 p.m., if the market is coming towards this range, even for 1 minute, at some point of time, if you keep on tracking the MTM profit or loss, at some point of time, you will see the profit. You can book that profit if you're getting 1:1 or 1:2, or let's say if you're getting 2% of ROI of your capital, you can book the profit. So the thing is, if you're not doing the adjustment, you need to be very careful and wait before 3 p.m. at any point of time, whenever the market is coming to close to your deployment level. This is where you're deployed. Whenever, due to V-shape recovery only, that can happen, right? So that means either the market has to go up like this and then do the V-shape recovery, V-shape reversal, or market has to go down like this and then do the V-shape recovery. So whenever this V-shape things forms on the expiry day, after 2 p.m. especially, and if the price is coming back to your opening deployment level, that is when, even if it's for 1 minute, you will see the very quick profit. And let's say you did not book the profit and market went up like this, you lose the entire money. That means the profit will turn into loss immediately. So you need to be very quick over there to book the profit, especially in this strategy. So that is how this works, especially on expiry day strategy. This cannot be deployed on other days. Only on expiry day this is suitable. Because even to do that is without adjustment I'm talking. Sometimes what can happen is market can keep trending in any one particular direction without doing a reversal or a retracement. In that cases, if you're not doing the adjustment, you may end up at a loss. But make sure that whenever you're deploying, you need to be ready to be able to accept the max loss. So how to check the max loss? Now look at this. Now this is my max loss. 1,300 and 1,100 is the max loss for one lot. So like that, let's say if I can take a max loss of 4,000 rupees, what I'll do, I'll increase this. I'll just multiply lot multiplier 1, 2, 3, approximately 4. Now let's say if I can risk up to 4,500, if it is within my 2% of the risk level, then I can take like 4 lots and do this. Now what happens is, let's say market is at around 2:30 p.m. and market is trading over here on upside. But due to a quick fall, suddenly the market reversed. The moment the reversal comes now, immediately, even if I'm having a loss of, let's say, like 3,000 or 4,000 of a loss at this point, immediately when the market comes here, you'll get a profit of 10,000 or 15,000 or 20,000 because your max loss is 25. So you'll be getting a profit of 15 or 12 or something like that. Immediately you can close it off. But if you're waiting for it too long without thinking that you may get even more profit, there's a chance that market can either go down again or go back on upside. In that case, again, you will be get at a loss. So this is a strategy which as and when you deploy, you will get to know more thing about it. There is no default way to, like, it's not like you deploy at 9:30 and then close it at 12 o'clock like that. As and when you keep watching it, at some point of time, no matter if you deploy at 9:30 or 9:50 or 10 o'clock, etc., at some point of time, due to the market momentum, you may see profit. If it is within 1:1 or 2% of your capital, it's better to book it off. So that is the inherent logic behind the call butterfly expiry day strategy without adjustments. Because to do the sell adjustments or a call sell adjustments or a put sell adjustments, you need to have more capital. So especially if you're not having more capital, then this is not, the adjustment thing will not work out. Without adjustments, you can just keep checking, but make sure that the max loss, whatever you're taking, should be within 2% of your capital, so that you need not worry. Even if the market trends heavily, you should not be worrying about it, because you know that you're not going to lose more than 2% of your capital. And how much capital it requires for one lot would be approximately 60,000 of the capital. It will be even lesser. It will be 40 or 30,000, because now the premiums are higher, because we are looking for the Friday values. On expiry day values, the values will be much lesser. So your premium requirement also will go down. The funds requirement also will go down, margin requirement. So that is the concepts. Basically, of course, like if you're a beginner in the options and just trying to attend this, it won't be clear. Some of the topics might not be clear. I'm assuming that you might be having some knowledge on the options. It's not like I'm teaching it from the very beginnings level. It's already been shared. And if there are some things which are not understood properly, now since I explained this now if you read this, maybe if somebody is not understanding previously, you may understand a little bit a better manner, like when to exit, when to book the profit, etc. kind of thing. So I mentioned and wrote clearly. It would be helpful if you are active to exit at the right time. Otherwise, you may miss the good exit opportunity. If somebody is reading this particular post without having understanding of what I mentioned, maybe he'll not be able to correlate it. Now, if I'm saying that you'll be having this range, that means if you're having this range, you need to be active. Whenever the market comes to this range, you need to check and close the position. That is what this line is about. So everything that I am mentioning, there will be definitely some important thing would be there. It is depending upon the person who is reading it and their knowledge, how much they are able to capture that from that particular post. So that is the whole concept of today's session. If you have any questions, please comment it down. Also, the Instagram post that I was referring to in the video has been pinned in the description. You can check them out and then save it for later. Also, to get quality insights on trading and finance, just subscribe to the channel and follow us on Instagram. Until next time, this is Arun signing off.